EM guru Adrian Mowat was in town. He decodes the market moves, talking about how investors must approach the volatility in equity markets as also currency markets.
I think it helps the bullish hypothesis. If you think about the underperformance in EM year to date, I would argue the main driver has been that the US economy has been growing much more rapidly. Earnings growth was something like 24% out of the S&P. And that meant that global investors were better off just sticking with US equities rather than emerging market equities. Now, there are also some other factors at work, and this is where I think the Fed's comments are important. The dollar has generally been strong, and emerging market currencies have been weak. So for an international investor, you are concerned about the currency. Now, the Fed's comments, I think, shift the probability around the dollar for the dollar being strong to actually being weak, because the expectations of another four moves by the Fed by the time we get into the middle of 2020 now look less likely. And I think that currency markets will begin to discount that. The dollar will weaken. And the EMFX, including the rupee, which I had argued overshot on the downside, are going to begin to recover. And we're already seeing that. I mean, look at the move in the rupee. We were at 74. We're now below 70 in a very, very quick move.
Right. If we were to really, bifurcate the entire emerging market back in two, one are the commodity manufacturers or producers like Brazil, Russia, etc., and the other commodity consumers like India, Indonesia. What's the outlook, the 12-15 month far out, in the light of how crude oil actually come down, also the dollar movement? What's your view?
So I think we're looking specifically at crude oil. The move that's happened in crude oil is very bullish for the Indian economy, the Indian market. It means that probably the inflation forecasts for next year are now too high rather than too low, and that the pressure on the RBI to continue to raise rates, and remember the consensus expects another 100 basis points from the RBI, may not come through. So I think that's very bullish for the Indian market. I don't tend to look at too much this commodity versus non-commodity, just because the Russian stock market is very, very small. And in the Brazilian stock market, I think the Brazilian story is much more to do with the change in government. I think a more conservative macroeconomic policy, which will help people's confidence in the domestic economy. I think if we wanted to split into two the asset class, I would split it into those that have been very negatively impacted by the trade dispute and China's slowdown, which is China, Korea and Taiwan, and those that are less impacted by that. So we've had significant underperformance of China, Korea and Taiwan this year. It is possible the Chinese economy begins to stabilize and recover, that you see quite a significant outperformance of China, Korea and Taiwan, where valuations are very low, sentiment is poor, positioning is quite poor. And I think that could be the rewarding trade for next year, and that would be the key driver of a meaningful outperformance of the EM.
How do you see the relationship between China and America progress from here on? There have been, hot and cold winds blowing both sides, but one sense is that it is imperative for equity as an asset class to do well globally, particularly emerging markets, only if the relationship progresses in a more balanced manner. What's your thought there?
Yes, so really we're not talking here about China versus the United States. We're really talking about the Trump administration and their positioning here, because I think China to some extent is a bit of a passive player in what's going on. Now, Lighthizer and Navarro, who are Donald Trump's advisors, they have consistently had a very hawkish view on China. And Donald Trump, 3 decades ago, was writing about trade deficits and how these were negative things. So we need to understand that their views are very entrenched. Now, in saying all of that, the US did come to an agreement very quickly with Mexico as they renegotiated NAFTA, and then with Canada. They have had a truce with the European Union.
So entire last 12 months we've seen emerging markets, and India in particular, been on the receiving in terms of flows? We only saw outflows. FIs have been booking profit out of emerging markets and hiding perhaps in the American markets or developed markets because of hopes that the rate cycle will only progress from here on. Do you see chances of that trade reverse now in favor of emerging markets going forward?
So a key part of my presentation was looking at earnings per share of EM versus the United States. And so we're talking here about equities, and it's growth investors that buy emerging markets. So the first condition they must have is a higher level of earnings per share growth in EM versus the US market. This year, the differential was something like 14% in favor of US EPS growth versus EM. That is why capital has been going into the US and coming out of emerging markets. As I look at forecasts for 2019, the EM EPS premium is going to recover versus the US, and I think that will support an outperformance of EM, plus you'll get a currency move, and capital will accelerate into emerging markets, and India will get its share of that.
You also, I'm sure, in your daily course of work, interact with a lot of fund managers who look at emerging market as they're hunting for ideas. What's their stance towards India in particular now that the broader markets valuations have corrected quite reasonably? Is there willingness to take a fresh look and deploy money?
Well, no, because I think you need to look at this from the perspective of an EM manager. So year to date, the Nifty index is up in India. In China, the Shenzhen and Shanghai indexes are down 20%. So investors have been positioned typically overweight India as they viewed this as a more defensive market, less impacted by trade disputes. And less impacted by the China slowdown. I think the risk for India over the next 12 months is the factors that have driven the outperformance of India will change. And so you'll probably see the average EM fund manager move from overweight India to maybe more of a neutral position. There could also be some risk management going into next year because there is a general election. The general election, the assumption from the international investors is that the BJP-led government remains in place with a reduced majority. But that is the base case. Perhaps people might, as the political campaign heats up, decide to do a little bit of risk management, and that, at the margin, could see some outflows.